Happy New Year! And this is the start of the year 2023. 2022 was a tough year for most investors as most saw their portfolio returns falling into the red zone. Atan asked how our local Straits Times Index performed against S&P 500 and Hang Seng Index during the past 1 year, 5 years, and since inception many years back. Wow, Atan, so greedy ah. Atan says, be greedy when others are faithful, well, be faithful when others are greedy. Sounds familiar? Let's jump straight to the topic. For S&P 500, let's use the blue line, red line for Hang Seng Index, and green line area for STI. For the past 1 year, as we can see from the 1 year chart, at the start of January 2022, the market seemed to be recovering, especially for the Hang Seng Index. Crackdowns on their tech firm were imposed by the China government. With the ongoing pandemic, the market just spiraled down for the Hang Seng Index. From February 2022 onwards, world events such as the Russia-Ukraine war expedited oil price surge and caused a food crisis. China's zero COVID policy affecting world manufacturing and export. Coupled with inflation, we saw the CPI of countries raised to all-time highs since the last great financial crisis. US CPI hit an all-time high of 9.1% inflation rate in June 2022 and came slightly down, yet exceeding analysts' expectations for the following 2 months in July and August. That's when we saw another fall for the S&P 500 in June 2022 to August 2022. For the Straits Times Index, it is a breed of its own, as STI is made out of the top 30 track-listed companies in market capitalization weighted. The 3 local banks already make up of more than 50% in holdings, and the financial sector holds nearly 50% of weightage. Despite the ongoing global events, Singapore is one of the first countries to open its border, and being a financial hub, Singapore stands to benefit as overseas investors and institutions seek to establish their headquarters and operations here. The rising interest rate environment benefited financial sectors such as banks as their interest margin increases. Banks are also able to offer higher rates of savings and deposits to the consumer. The 1-year annualized returns of STI as compared to S&P 500 and Hang Seng Index looks defensive against all odds. Let's go back to the 5-year annualized returns of the 3 indexes. From 2018 to February 2020, we can see that aside from S&P 500 being in positive returns, both STI and Hang Seng Index were in the negative performance returns before the COVID in 2020. All 3 markets saw a sharp drop of 30% in February 2020, with S&P 500 seeing a V-shaped recovery within the next 3 months. COVID also expedited the hype of tech stocks as people over the world are being confined and have to depend heavily on technology, be it work or their personal life. The low interest rate environment at the point also benefited speculators who used leverage either from margin account or from bank loans on investment and properties. For the case of the Hang Seng Index, it was not that fortunate due to the political climate between Hong Kong and mainland China or the withdrawal of the extradition bill during 2019 till COVID in 2020. Remember the ex-president of US, Donald Duck? Donald Trump. Yes, once Donald Trump assumed president of USA, he wasted no time in initiating a trade war to China in 2018 in order to make America great again, imposing tariffs on Chinese goods imported from China, while China retaliates with tariffs on US exports. Donald Trump subsequently declared a national emergency over threats against US technology, paving the way for a ban on Chinese firms. The situation was further escalated when allegations were made on China being a currency manipulator. The market fell further with both weakening currencies on both sides and possible further sanctions. Let's go back 10 years and more ago for the 3 markets. Coupled of financial crises such as the dot-com crisis, Asian financial crisis, and Great Financial Crisis happened during this period. The most notable will be the Great Financial Crisis, or known as the subprime crisis, which happened in 2007 to 2008, where markets fell more than 50% at the lowest in March 2009. The build-up of Great Financial Crisis 2008 started with high-yield bonds or junk bonds that were repackaged into mortgage-backed securities sold to mass retailers, guaranteeing principal and generating interest to the retail buyers for a fee. Firstly, such investment instruments benefited financial institutions such as Freddie Mac and Fannie Mae, providing them with high liquidity funds like cash, thus allowing them more lending activities such as expanding housing credits from middle to low income families amid the low interest rate environment after the dot-com crisis in the early 2000s. Secondly, the US tax system in the early 2000s incentivized homeowners taking mortgages such as interest payment are disallowed from credit card and car loans, in turn creating incentives for homeowners to use their home mortgages, which interest remains deductible, to pay off other debts or drawing out cash for personal use. Further deregulations from the US government subsequently allowed more credit lending activities, which increased the risk and leverages of the lenders. With the rising inflation rate from 1.6% in 2002 to peak of 4.3% in 2006, the Federal Reserve also raised interest rates from 1% to 5.25% gradually. Borrowers started having difficulty in making their mortgage repayments, and this directly hits the financial institutions such as bad debts accumulate, which most are based on these mortgage-backed securities, which were issued in the earlier years. Several big financial institutions such as HSBC reported huge write-offs in billions of the subprime MBS. Subsequent events followed with the bankruptcy of notable financial institutions like Bear Stearns and Lehman Brothers. American International Group AIG was fortunate to escape bankruptcy despite being one of the largest CDS providers due to humongous loan from the Federal Reserve. The events led to credibility and liquidity issues on the whole financial systems and spreads to the stock markets as well. The housing bubble burst and the failing financial system and stocks markets crashed in 2008. From October 2007 to March 2009, the S&P 500 fell 51%, Hang Seng Index fell near 55%, and STI fell 60%. However, over the long-term period of more than 20 years, the stock market will recover higher than before, as this could be seen on the S&P 500 and Hang Seng Index. Markets like Hang Seng Index over the past 2 years have been falling due to their political climate, COVID, and crackdowns. Institutional investors are starting to look towards investing in the Chinese market as the zero COVID policy is lifted and they believe the Chinese market is on recovery. On the other hand, the US market is not optimistic as the ongoing recession looms across different sectors. On STI, it's more on the defensive side. Do like and subscribe to my channel. As always, be hungry, be foolish, be creative. Adios.